Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk. Today is a special edition. I have my friend Rob from the Mindful Investor YouTube channel, and we wanted to do a podcast about dividend investing. So, welcome everybody, and let me introduce Rob once again.
Yeah, thanks for inviting me to this podcast, Alesh. Let's get started. I understand that you've done the dividend stocks for like 20 plus years, I'm guessing. so, so how have you found it? How tough was it at the beginning when everything is just like nothing? It's just $50 or $500?
Well, at the beginning, when I was filling in the paper orders in order to buy the stocks, no, I'm kidding. 20 years ago. No, I think I really got serious about investing in dividend stocks probably 12, 13 years ago, after I had a bad job where I was thinking, okay, how can I get income so I wouldn't have to work anymore? And that I think that really put the dividend investing in mind for me. So I started learning about it and sort of improved my style and tweaked it as time went along. So what about you? What made you get into dividends as opposed to growth stocks?
Um, yeah, I didn't start off with dividend stocks. I started off with growth and options. And my thought process of dividends is that this portfolio is much safer than my high flyer portfolios, and this it gives a better return than the banks. So that's somewhere in between, and then I'm still invested. So it's like a win-win-win situation for me. And I just started my portfolio maybe 5 6 years ago, and every single month I contribute pretty much the same amount, like $4 or $5 thousand, and right now I'm about to hit 500K. So
Nice.
yeah, that's a pretty big milestone.
So now, do you pull the dividends out and then when you have $5,000, you reinvest, or do you do a drip as well as the $5,000?
I I drip, and then on top of the 5,000. So sometimes you can't buy extra shares of the certain companies I'm holding because there's not enough money there. So it kind of fluctuates between 5,200, 5,300 every month. So I just distribute that to like maybe one or two stocks every single month.
Okay, so you handpick the stocks every month to do the larger purchases for.
Yeah. Sometimes I spot new ones. Sometimes I just buy the ones that's like kind of falling behind, which makes the dividend yield a little bit more attractive.
All right. Are you sort of rebalancing, or you're just looking at what is a better stock to buy because it's maybe down a little bit or the PE is lower?
Yeah, it's like a balance of both actually. Like my the percentages varies. Some are just like 1.5% because it just started at maybe like this quarter, and some are has grown up to like 12%. But I've never sold a single dividend stock. So if that 12% grows to 20%, I'm not gonna trim it down. I'm just gonna let it grow because I don't want to realize capital gains and deal with the taxes. This is just a black hole analogy for me. I just put the money in and just let it roll, and we'll see where it goes from there.
Well, that's what dividend investing is to me as well. It's a buy and hold, and if the stock goes down, you buy some more, and as long as it keeps paying the dividend, it's it's fine. There's no problem because that's what you bought it for. Uh,
Yeah, but one question you mentioned, like if the stock doubles somehow, will you trim it down?
well, my current portfolio says no. I have a couple that have doubled. I have GSY, for example, Go Easy, which is a basically a payday lender, who's tripled for me, and I keep holding them. I think I will only sell a stock if I think it's not going to go up anymore, if it's going to go down, and then I might just sell half of it. So yeah, I personally have some difficulty selling in general, but uh, with dividends, at least I'm being paid to wait, so it's okay that way.
So the definition of rebalancing is just buying the ones that's lower in percentages and trying to boost those up instead of like selling the ones that are higher in your portfolio and like balancing that way.
Yeah, for me, it's not really a formulaic activity. I think I'm much like you as I see, okay, this stock looks good, or I've read a couple of experts saying that this is their top pick, so that's the one I buy. I have about 40 to 50 dividend payers. And so for me, it's impossible to say that this one is out of balance. I just sort of have a favorite, and when the time comes, that's the one that I buy. I do look at my portfolio. So, for example, Manulife is my biggest holding, individual holding. I have mutual funds which are bigger, and so even though I still want to buy more Manulife, I don't, because you're not supposed to have more than 5% of your portfolio in a single stock. So I also avoid that. But so for example, this past week I made some purchases, and Bank of Nova Scotia came up on multiple expert reviews as being the stock to buy. So that was included, even though I still had a significant position in Bank of Nova Scotia as well. So it goes by gut feel, after doing some review, I guess.
Okay. Okay. I just logged into my account and then like my account is like balance of like stocks and ETFs. So my ETFs are just index funds. Right now that is about 25% of my portfolio. Like how about for yourself? Do you buy a lot of index funds or mutual funds?
Uh, about 60% of my investable portfolio is individual stocks, and then about 40% is mutual funds and ETFs. Um, I use stocks for the dividends, and then the mutual funds and ETFs seem to be more growth for me. With individual stocks, you can control exactly what you're getting. With mutual funds, you pretty much depend on, or ETFs, you depend on whoever's running it. So I guess I like the control. And if one day the ETF decides that they're going to get out of companies that get 4 or 5% yield and get into 1 and 2%, I don't really have anything I can do about it, and suddenly my yield starts drifting down. So yeah, the individual stocks give better control. Plus, you just pay the commission once, and because I don't trade, it ends up being cheaper as far as fees go as well, because I'm not paying the mark. So
Okay.
yeah, the other thing is I found dividend payers are generally large companies for me. Um, have you found any small companies that also pay decent dividends?
That really depends if by decent you mean just the yield or the growth of the yield. Like one of my stocks is Equitable Group Bank. They
Hmm.
only pay like 1.2%, but then they grow at like 10% per quarter. Like no, not per quarter, per year. So over 5, 6 to 7 years, it doubles in dividend payouts. So and the capital gains on that has grown a lot as well. So like sometimes I don't purely look for like the 4 or 5%. That's not the main criteria. Sometimes you have to balance it with the growth and with the some capital gains. So it's kind of hard just to nail it on that criteria. Is like if it's over 4%, then I'll take a look type of thing.
Right. Yeah, I guess it depends on the company. I know that if you're going to hold the stock for 20 years, then yeah, even if it starts at 1.2% and it grows 10 a year, it's going to double to 2.4 in 7 years and double again to 4.8 in 14 years. So you really have to hold it for a long time compared to the stock that's been paying 4.5% from the beginning, but maybe growing not at all. That's gonna win out because it's been paying 4% the entire time, while the other one had been going up to that 4.8 in 14 years. So yeah, like I've looked at, I think it's Canadian National Railway. I think they pay something like 1% or 1.5%, but they're growing it quickly. It's just it'll take a while to catch up, and I mean you can do the math on that.
Yeah, it goes back to like how the businesses are like ran, right? So if it's like a bigger blue chip companies that doesn't grow very much, then they pay more dividends. If it's a small company, they use the dividend payouts and they grow their own company bigger, faster, right? So that's the capital gain side. Like,
Yeah, you should ideally be, or I'm kind of thinking that I should be targeting the total return, but still the dividends kind of feels good. I know you can kind of take two forks in that road. You can either go the dividend side or you can go the growth side. And then when you need money to live on, like I do, then you can sell something. The only thing is maybe there's nothing to sell. Maybe there was a bit of a pullback and you don't really want to sell anything when it's gone down. While with the dividends, companies are going to try their hardest not to cut the dividend because then their shares would drop. So the dividends are always going to be there, or most of them. While with the growth, it's kind of tough. But yeah, you could get a company that goes up 20% a year. That sure beats that 4 or 5% dividend. So it's good to have a mix of both, and then you can make decisions as to what you want to do. But yeah, I always imagine small companies are sort of going up and maybe they're not paying any dividends, or they're paying enough dividends just to say that they're paying dividends, because there's going to be mutual funds that don't buy companies that don't pay dividends. So whenever you see, a 0.2% yield, then it's like, okay, this company is just paying a dividend just to say that they're paying a dividend, right? It's
yeah,
an actual giving money back to the shareholders. So,
yeah.
uh, but yeah, an up and coming company that's small probably isn't going to pay anything. But once the growth stops and it becomes a stable company, in in order to attract more buyers, and because they can pay a steady dividend because now they're a cash making machine, that's when the big companies start paying the hefty dividends. So any company whose name you recognize in Canada is probably one of those large companies that pays. So one of the things that we dividend investors look at is, can the company continue to pay the dividend that it is currently paying, or increase it preferably? So what kind of metrics do you use personally in order to determine that the dividend isn't going to get cut?
Well, there's like no real like crystal ball for this, but then we a lot of times you have to look at track records like dividend aristocrats, like if they paid out for the past 25 years and increased the dividends every single quarter, every single year, and somehow some way after you bought it, it started tanking and they started cutting. So like you can't, like this stuff like happens, but what are the odds, right? Like, I mean, I haven't experienced dividend cuts yet. I think only in like a US stock for Disney, but then that's only they weren't really considered to be like dividend stock because they only paid out like 1.2%. Like you said, it's just for the sake of being paying out dividends, but they cut it for like a quarter or so, and then the stocks actually went up after all the bad news kind of like tapered. So other criteria is like payout ratios. A healthy one would be like 60-70%, but right now some of the utilities are like 130%. So I treat that as an outlier. So I hope within the next 2 quarters they can fix things up and kind of bring it back to the norm of like 60-70%. If they don't do it for like a year of like more than 100% payouts, then these are huge red flags. But then I think by that time the stock price will probably reflect already and it's dropped like by 30-40%. So you really have to see if you trust the company and they can actually bounce back.
Yeah, yeah, no, absolutely. I think a lot of it is in the business practices and the company itself. But so you're right. So unfortunately, there's multiple metrics that you can use, and it generally depends on the sector as far as which one you want to use. So for financials, I look at the dividend payout ratio, which is the earnings per share, uh, and the so you go the dividends per share divided by the earnings per share. And you're right. So with a bank, for example, I would be looking 40 to 60 would sort of be the sweet spot. That means that they're only paying out 40 to 60% of the profits that they make in dividends. Now uh, for certain companies, so for telecoms and tech companies, for example, I tend to use the free cash flow, where you take earnings, but you're adding back in the depreciation and amortization because those are treated as expenses. So those are subtracted before you get the final profit, but they're not actually impacting the cash that the company has coming in, which is what ultimately reflects their ability to pay the dividend. So you have something like uh, Bell Media, whose payout ratio, when you look at their actual profits, is over 100%. So you're thinking, well, they're borrowing to pay the dividend. Well, they're not, because they have a lot of infrastructure which they're writing off and expensing, so that's lowering their profits. But as far as the cash that they have coming in, they're able to keep paying the dividends. And then the third one is companies that have a lot of capex. So, for example, Enbridge, they have yet a third calculation, which they usually provide on their website. It's usually called distributable cash flow. And they calculate it for you to kind of tell you, after adjusting for the capital expenditures that they have to make in order to grow their business, they're telling you how they're able to pay. So it's very tricky. And of course, things can change as well at the drop of a hat. I have had Suncor cut their dividend about a year ago, but usually, well, sometimes the stock price does go down further, but sometimes the investors say, okay, you did that to save the company. We understand and we forgive you. And the stock price might actually go up when the dividend is cut. So,
Yeah, it's kind of like the buy on bad news type of investment mindset.
yeah, yeah, the stock price had probably already factored that in and it was already down. And so now when they actually announce it, what's sort of annoying is that up until then, the management swears up and down that they're not going to cut the dividend. We're not going to cut the dividend. And then one day they just cut it, and they just say we did it to save the company. And yeah, so why don't we call it a day? Uh, I've been Alesh Eisner, and this has been Rob from the Mindful Investor. We are going to do more of these podcasts in the near future, so look for those. And I will wish everybody a profitable day. All right.
Thank you.